Channel. I'm Doris and I'm here to share with you about the stock account update and today's market. Today my stock account has earned $4,867. On the other hand, the Dow Jones Industrial Average fell nearly 700 points and the S&P 500 fell below 4,000 points. In my account today, SQQQ rose for more than 7.1% today to 38.87, and the RV rose 6.18% to $45.68. In total, the net asset of my account is $76,000, and the total PL is a loss of $24,000. In the market today closed down with the Dow Jones Industrial Average lost 2.06%, Nasdaq lost 2.50%, and S&P 500 lost 2%. All of the industries showed in red here made a significant loss, with internet retail made a loss. Internet retail and the auto manufacturers made a loss of more than 4%. U.S. stocks closed lower on Tuesday, with the Dow down nearly 700 points and the S&P 500 falling below the 4,000 mark. The dollar strengthened and the Treasury yields climbed. Investors are concerned that the Fed will continue to raise interest rates and keep them high, that will lead to a recession. The latest earnings report indicated a shift in poor performance among consumers. The latest U.S. stock market results signal a poor outlook for consumer spending. Home Depot, a Dow component decoration goods retailer, reported lower than expected fourth quarter revenue and issued bleak guidance. Walmart reported its first full year of profit decline in 6 years. The company was cautious about its outlook for this fiscal year amid rising economic uncertainty. The company CFO John Rainey said Tuesday that consumers are being squeezed as interest rates rise and savings rates fall, threatening spending. The climb in short-term Treasury yields further weighed on the market sentiment. The yield on the benchmark 10-year U.S. Treasury note climbed up to 3.9% Tuesday, while the 2-year yield rose to 4.7%. Continuing last week's yield rally, both hit their highest level since November. Treasury yields rose because higher than expected inflation have left traders worried that stubborn inflation would lead to the Fed to hold higher interest rates for longer and plunge the economy into the recession. The Fed will release the minutes of the FOMC monetary policy meeting from January 31st to February 1st on Monday. The bank raised rates by 25 basis points at that meeting. Goldman Sachs chief economist Jane Jesus estimated the Fed will raise interest rates by 25 points each month at its March, May, and June meetings. He said recent inflation figures were far stronger than expected, and that January was expected to soar. This will not necessarily break the slowing inflation trend, but it will reinforce the idea that the Fed has work to do. The Fed raises another 75 basis points and will not cut rates by 24% for 2024. This seems more likely. When asked whether the Fed would resume the prospect of a 50-point hike, Jesus said he was skeptical but did not want to rule it out altogether. Michael Wilson, a Big Short and Morgan Stanley strategist, said they're too expensive and are sending warning signs that S&P 500 could fall as much as 26% in the first half of the year. While recent data suggests the economy may avoid a recession, the Fed cannot change policy direction, Wilson said, which does not bode well for the U.S. stocks. The sharp rally this year has taken the stock market to its most expensive level since 2007, and the stock risk premium has entered the death zone. Wilson said risk returns on U.S. stocks are very poor, especially as the Fed is far from ending monetary tightening. The interest rates curve remain high and earnings expectations remain 10% to 20% higher. The risk of a U.S. default is looming, and investors are forced to cut down some of their exposure to Treasury debt. Bond investors began reducing their holdings of treasuries on Tuesday to deal with a possible government default. In their view, the chances of a U.S. government default are slim, but it could have a huge impact on global financial markets. The Treasury Department hit a $31.4 trillion borrowing ceiling last month. Unless Congress raises or suspends the cap, the U.S. government may begin defaulting on bonds that support global financial system, considered one of the safest investments. Some bond managers have begun adjusting their short-term exposure to treasuries to avoid losses while the government could run out of solvency. Preparing for a potential default is a tricky business, partly because it is uncertain how much the Treasury will receive from Americans who will file income tax in April. That's all I have for today. Thank you for listening. Don't forget to subscribe and like. See you next episode.